This is my actual stock portfolio. Not a printout. Not a mock-up. The real thing. And in this video, I'm going to walk you through 9 stocks across 4 completely different technologies that are shaping where growth is happening in the market right now. Because when you are evaluating a company, the products matter just as much as the numbers. A great balance sheet attached to a mediocre product rarely stays great for long. To understand why getting in early on the right trend matters so much, look at the math. $10,000 in AMD 5 years ago would be worth roughly $60,000 today. $10,000 in Palantir just 3 years ago would be worth roughly $160,000. That kind of growth tends to happen when a company has the right product positioned in a market that is about to expand, before most people have noticed the market exists yet. Let me be transparent about volatility first, because that is the real cost of this kind of investing. My portfolio dropped by as much as $80,000 at one point this year. It has recovered since, but that swing is real and it does not go away just because the long-term trend looks good. If we zoom out, that volatility is probably going to stick around. The flip side is that volatility also creates entry points for stocks that may have dropped further than their underlying business justifies. Let's start with the first category. Big tech stocks that look reasonably priced at today's levels, before we move into higher risk, higher potential names later in the video. The first stock here is Microsoft, down nearly 25% over the past year. This is not a company likely to multiply 10 times from here. But based on how it is valued relative to other big tech names, it may be undervalued at current prices. Let's look at why the price has dropped, what the numbers actually say, and where leadership is positioning the company for the next wave of technology, including AI and quantum computing. Part of the pressure on Microsoft's stock has come from public perception issues. Windows 11's push to integrate more AI features has frustrated a lot of users, with some feeling it functions more as an advertising vehicle than a genuine improvement. In a competitive environment that is intensifying, Microsoft cannot coast on its consumer products the way it once could. Security warnings from federal agencies have not helped either. But the numbers tell a more nuanced story. Microsoft's personal computing division actually saw revenue decline by 1% over the past year, which lines up with a lot of the consumer side criticism. But their productivity and business segment revenue is up 17% year over year. Their intelligent cloud business is up 30%. The company is clearly shifting weight away from consumer products and toward the B2B side of the business, selling directly to other companies. That shift also explains their infrastructure spending. Microsoft plans to spend $120 billion on AI infrastructure in 2026, an 85% increase year over year. In the context of their B2B strategy, this functions almost like a loss leader. AI gets customers in the door, and once they are in, Microsoft can sell them into higher margin areas like Azure Cloud Computing or Active Directory. Even if a competitor builds a better AI model, that model likely still runs on Azure's infrastructure somewhere. One detail in their most recent earnings caught my attention. Total capital expenditures actually declined for the first time in recent years, to $31.9 billion in a single quarter, while still keeping them on pace to hit their full-year target. That suggests this is not an unlimited spending spiral. Microsoft appears to be executing against an actual plan rather than spending reactively. On valuation, Microsoft's forward price-to-earnings ratio sits around 22, noticeably below the sector average of roughly 33. That gap suggests the stock could rise meaningfully and still only be sitting at the industry median. None of that guarantees it happens, but it does suggest the current price is not stretched. Microsoft's product roadmap adds another layer. Project Solar, their approach to embedding AI agents into everyday workflows, includes use cases like a hospital nurse using a wearable device to pull up patient information instantly. It is one of the more genuinely practical AI applications I have seen, even if it will not move revenue immediately. On a longer horizon, their Majorana 2 quantum chip claims qubits 1,000 times more reliable than their prior generation, pushing toward scalable quantum computing applications in chemistry, research, and security. Microsoft probably will not multiply dramatically from here. But it has both near-term and long-term potential, and it offers a relatively stable foundation to balance against riskier names later in this list. The second stock under this big tech value lens is Broadcom, up about 50% over the past year, but still showing solid growth ahead despite already being one of the largest companies in the world. Broadcom operates across 2 core categories: networking, and chips. Their fiber channel adapters are designed for zero-trust, quantum-safe data transmission, embedding intelligence directly into network interfaces. They also produce enterprise-scale storage solutions, addressing another common bottleneck in AI infrastructure build-outs. Broadcom is not flashy, but they supply the foundational components that modern data centers require. Two catalysts stand out. First, the company is sitting on nearly $15 billion in cash, giving them flexibility to retire outstanding debt as rates rise, and to partner with firms like Blackstone on large-scale AI infrastructure deployments exceeding 20 gigawatts globally. Second, their AI revenue is accelerating, with 200% year-over-year growth expected in the third quarter. Holding significant cash in the current AI environment is a meaningful competitive advantage, particularly compared to companies like OpenAI, which is reportedly losing $39 billion annually. Broadcom's Q2 semiconductor revenue increased 143% to $10.8 billion, out of total revenue of $22 billion. Their forward price-to-earnings growth ratio sits at 0.77. Generally, anything below 1 suggests the market may be undervaluing the company relative to its growth trajectory. Moving away from big tech into a more speculative but maturing category, space technology. To understand this space, you have to start with what is happening around SpaceX, Blue Origin, and increasing government launch activity. Currently, 70% of launches are conducted by commercial companies, and interest in space access has grown sharply in recent years. According to a 2024 McKinsey report, the space industry is projected to reach $2.5 trillion annually by 2035, which would make it one of the fastest-growing technology markets in over a decade. Rather than betting on individual space companies, which carries significant single-stock risk, a more balanced approach is investing in the broader ecosystem through ETFs. This mirrors how early computing hardware enabled an entire software industry, or how smartphones enabled an entire app economy. The VanEck Space ETF, ticker WP, holds roughly 23% of assets in SpaceX, with Rocket Lab as the next largest holding at 14% and AST SpaceMobile at 5%. The ARK Space and Defense Innovation ETF takes a different approach, holding under 10% in SpaceX with larger weightings in Rocket Lab, L3 Harris, Kratos Defense, and Redwire, covering a broader set of innovations across batteries, 3D printing, and autonomous systems. Both carry real volatility and neither should be checked daily, since daily price watching tends to add stress without adding insight. The next category is quantum computing, an area that recently saw the U.S. government take a $2 billion stake across several quantum companies. The quantum computing market is expected to grow at 32% annually, potentially reaching $170 billion by 2040. IBM stands out here, up nearly 87% over 5 years despite being down roughly 10% year-to-date. IBM has received close to half of total U.S. government investment in the quantum space, building on quantum research dating back to 2019. Their business breaks into 3 revenue streams: software at roughly $25 billion annually, infrastructure and cloud hardware at roughly $3 billion, and consulting services that help enterprises adopt these systems end-to-end. Their Qiskit software remains the most widely used quantum development toolkit, with over 13 million downloads and 69% developer adoption as the primary quantum SDK. IBM's forward price-to-earnings ratio sits roughly 25% below the broader market. The primary risk is timeline. Quantum computing remains largely confined to research and specific cybersecurity applications today, and meaningful enterprise adoption could take years to materialize. For investors who prefer diversified exposure rather than a single quantum stock, the Defiance Quantum ETF, ticker QTUM, surpassed $5 billion in assets following the government's quantum investment announcement. It sits in the large growth category with relatively high volatility but solid liquidity, unlike funds with multi-month lockup periods. The main consideration is that many of its largest holdings, including Micron, Marvell, Intel, and ARM holdings, function essentially as general semiconductor exposure, since quantum chip production is likely to be handled by existing chip manufacturers as the technology matures. Worth noting separately, large-cap stocks currently appear broadly undervalued based on Morningstar's analysis, mid-cap stocks appear slightly elevated, and small-cap stocks appear undervalued as well, suggesting the market's perceived value is concentrated at both ends of the size spectrum rather than the middle. Shifting to Fintech, and one of the largest individual holdings in this portfolio, SoFi. The company is growing revenue at 30% compounded annually, scores 72 on the Rule of 40 investing framework, yet the stock is down 37% year to date. SoFi stock has dropped from the high 20s to a range between $10 and $17 over the past 6 months, mirroring a broader fintech downturn. The global Fintech ETF has fallen 20% over the same period, while the broader financial sector ETF has stayed roughly flat. Two structural factors explain this gap. First, total commercial bank deposits surged nearly 50% since 2019, boosting the financial sector broadly. Second, and more concerning, is growing unease around private credit, now an estimated $1.5 to $2 trillion market spanning hedge funds, insurers, pension funds, and banks like SoFi, all lending heavily to fund things like AI data center construction. The interconnectedness between these players has raised concerns about systemic risk, particularly as rates are expected to keep climbing through the remainder of the year. This connects directly to SoFi's business model. They acquire customers through accessible products like their investing app or credit card, then upsell them into higher-margin lending products: home loans, student loans, personal loans. SoFi originated $3.88 billion in personal and home loans in Q1 of 2026 alone, with lending revenue growing 53% year over year. This drives significant growth, but also significant exposure. Any instability in credit markets, lending markets, or the broader technology sector tends to hit SoFi early and hard, which explains the volatility. This portfolio currently holds 2,500 shares of SoFi, valued around $43,000, making it the third largest position behind CrowdStrike and Vanguard Holdings. In the short term, macroeconomic conditions, interest rates, and sector-wide sentiment will likely dominate price movement more than company-specific news. Longer term, two opportunities stand out. First, SoFi's growth as a standalone consumer bank brand, recently ranked #1 on Forbes' World's Best Banks list and #1 in J.D. Power's U.S. Investor Satisfaction Survey, with roughly 500 million legacy bank accounts in the U.S. representing a large addressable market if trust can be built. Second, SoFi's role as a fintech infrastructure platform for other companies, powering services like Robinhood's checking and savings accounts through their Galileo platform, and their newer big business banking product supporting both fiat and crypto banking for other businesses. If that second opportunity plays out over the next decade, SoFi could function similarly to how AWS underpins much of the internet, but as infrastructure for finance instead. That is a long-horizon thesis, and in the near term, the stock will likely continue moving with broader lending sector sentiment. The final category is AI chip infrastructure, the companies building the actual tools and equipment that power AI build-outs, generating real profit rather than just growing market share without earnings. Teradyne sits at an interesting intersection of quantum computing, AI chips, and robotics. They are a leader in testing and integration equipment for the latest generation of chips, using their analytics expertise to create a feedback loop where improved AI enhances their testing capability, which in turn enables better chip production. Their work spans from testing raw silicon wafers through final installation in AI data center racks, and it has won them significant contracts, including a $140 million U.S. Air Force agreement. Their expertise has also earned them a reputation as a potential quantum supply chain bottleneck, though that application remains years out. Teradyne owns Universal Robotics, which has sold over 100,000 robots across industries, including warehouse automation systems capable of detecting and interacting with inventory autonomously. The company generated $1.3 billion last quarter, growing 87% year over year, with the majority of that growth driven by AI applications. Two risks are worth understanding before considering this stock. First, the semiconductor market is historically cyclical, moving through roughly 5-year boom and bust cycles. If the last downturn was 2023, the next would be expected around 2027 to 2028, unless offset by continued AI infrastructure spending. With 70% of Teradyne's revenue tied to AI, a cyclical pullback would be a real exposure. Second, valuation. The stock currently trades at a forward price-to-earnings ratio of 63, well above the typical 23 to 24 range for hardware-focused companies. Given their 87% year-over-year growth, some premium is reasonable, but it is a meaningful risk factor to weigh. The final stock in this breakdown is ASML, which holds what is functionally a near monopoly on the machines required to manufacture the most advanced chips using high-NA extreme ultraviolet lithography. These machines cost roughly $250 million each and use lasers to etch circuit patterns at a scale no alternative method currently matches. This is effectively the only viable path to producing the chip generations powering the most advanced AI processors today, which is why ASML's position is so structurally dominant. Their next-generation machine reportedly carries a $400 million price tag, monopoly-level pricing that makes sense given their customers operate at multi-trillion-dollar market caps. Barring a major competitive shift or a breakthrough alternative method, ASML's position looks durable from current levels. That covers all 9 names across 4 sectors. The full portfolio, including positions not covered in detail here, will be shared for anyone who wants the complete picture.